Hello everyone, and welcome to the Aardvark Tax Update Extravaganza. I'm Sean, a customer service representative and enrolled agent here at Aardvark Tax. This is the first of what's going to be an annual set of videos detailing the big tax changes for the year. We're planning on putting out a video like this every April, and then a follow-up video come November. It's currently April 2023, and this update covers the changes you should be aware of for the 2023 tax year. Keep in mind, however, that Congress can and does change tax law all throughout the year. They will not finalize 2023 tax law until December or January of 2024. So remember that we're also working with a divided Congress who will be fighting 24/7 about the debt limit and trying to lock in a budget. So I actually wouldn't expect them to do too much on tax law work this year other than to just finalize taxes in December. Though I do wonder what will happen if Congress can't get its act together and pass the debt limit. But let's not think about that right now. Instead, let's go with the understanding that Congress can change anything at any time, and the information I'm about to give you right now is accurate as of April 18th, 2023. Tax Day. Happy Tax Day. Now, I may discuss how some of these changes relate to California and Oregon because the vast majority of our preparers work in those two states, but don't worry, this won't be a West Coast-centric video at all. Okay, before we get down to business, don't forget to subscribe by clicking the button below. That will ensure that you get notified about our follow-up video that we're planning on making in November. And that's going to detail all the ways you can prep your clients for the things they need to do before the year ends so that they have a good April next year. And one last introductory thing, if you're watching this video without it being included in one of our Aardvark Tax courses, you aren't getting continuing education credit for it. So if you want the credit with either the IRS, California, or Oregon, please be sure to go to www.aardvarktax.com, and the link will be below in the text below this video, and sign up for a class today. Okay. Time to get down to it. What are the tax changes you need to be aware of for tax year 2023? Let's move on over to the wall so we can use the display over there and see what's going on. All right, so here we go. The first update that we're going to talk about is both the most and least significant of all the updates. How is that possible? Well, because it involves a filing status. The qualifying widower status has been renamed to qualifying surviving spouse. So expect all your forms for tax year 2022 and beyond to reflect this change. This change also applies to many states such as California and Oregon. We haven't checked for all of the income tax states yet, but I assume that this change will likely apply to them all. It's significant because we haven't had any changes to the filing statuses in many years, but it's totally insignificant because we haven't found any other changes that apply to the status other than the name change itself. So just be aware that the name has changed. Okay, it's countdown time. Let's take a look at the countdown for the Tax Cuts and Jobs Act of 2017. Countdown, you ask? What do I mean? Well, the Tax Cuts and Jobs Act provisions are set to expire in just 2 more years. Yep, that's right. Most of the big changes from the Tax Cuts and Jobs Act will expire at the end of 2025. Congress likes to put expiration dates on bills so they look less expensive to the general public when they are being debated. For instance, I might say I'm going to give tax cuts of $1 million a year to everybody. If they were permanent, that would end up costing the government $10 million over 10 years. But what if I put an expiration date on it? If I say that the tax cuts will expire just 5 years from now, then I could spin it to people that I gave them a tax cut of $1 million a year, but now it will only cost the government $5 million instead of $10 million. It's disingenuous to be sure, but it's a standard way that both parties in Congress make bills more palatable to the general public. And Congress did just that trick with the Tax Cuts and Jobs Act of 2017. Most of the provisions will expire at the end of tax year 2025, meaning that in tax year 2026, we revert back to the old tax rules. So goodbye to the 21% corporate tax rate and the high standard deductions, and hello again to exemptions and high state tax deductions. Of course, Congress can act in the meantime to create a new bill that will either extend the provisions on a year-to-year basis or make them permanent. Sometimes Congress does that. They do it on a year-to-year basis, such as what they did for decades with the educator expenses deduction before making it permanent in 2015. We had to wait until every January to figure out whether the deduction was going to be there. So how long do we have for the Tax Cuts and Jobs Act provision? As of today, April 18th, 2023, we have 1,005 days left before the bulk of the Tax Cuts and Jobs Act expires. We will, of course, let you know if Congress makes any permanent change in the future, but I will say it's extremely unlikely that Congress will make those changes this coming year. Okay. So we have the countdown out of the way. Let's talk about some of the other big legislation that has recently changed tax law. First up is the Secure Act of 2020, which focused on retirement. One of the major changes provided in the act is that it upped the age where folks are required to take distributions from a retirement account. It changed from 70 and a half years old to 72 years old for the 2022 tax year. And that number increases again to age 73 for this year, tax year 2023, and for several of the following years after that. The Secure Act also removed the age limit for contributing to IRAs, so anyone earning wages can get a deduction for contributing to an IRA regardless of their age. Of course, the usual IRA income limitations still apply, so nothing else changes other than that you can be of any age. Finally, don't forget the even older legislation that allows taxpayers of any age and income to convert traditional IRA funds to a Roth as long as it happens before December 31st of any tax year. You want to remind your clients of this because they will have to pay tax on the amount that was converted. We'll talk more about this in our November video when you're going to be prepping people. Next up, please be aware that several of the American Rescue Plan provisions have expired. For instance, the child tax credit expansion of $3,600 and the ability to get the credit in monthly installments both expired as of the end of the 2021 tax year. That means the monthly installments are gone and the amount of the child tax credit has dropped a whopping $1,600 per child back to the standard $2,000 created by the Tax Cuts and Jobs Act. Uh-oh. Who's that guy down there in the corner? That's little Mikey, and he's going to show up whenever we have a change that will surprise your clients, typically in a bad way. The expiration of the child tax credit provisions is a great example of where your clients can have essentially the same income and deductions for a year, but still owe a lot more than they did last year just because of a little change like this. Expect little Mikey to show up whenever I'm discussing a change that you might need to prepare your clients for. He's going to stick around now because we're going to be talking about one other thing. One of the permanent aspects of the Rescue Act added the new 1099-K reporting requirement for gig economy companies and workers. This provision requires that third-party settlement organizations report 2022 transactions on a Form 1099-K to the IRS for anyone that they paid $600 or more. This is a big change for self-employed giggers because in previous years, the reporting element was only required when payments exceeded $20,000. So that's a big difference. It was supposed to start with tax year 2022, but companies complained about the change and the IRS released guidance that they would allow the $600 threshold for one more year. They would delay it to 2023. So for tax year 2022, the threshold remained at $20,000, but for this year and upcoming years, expect Schedule Ks from all of your gig employment clients who make more than $600. Check back for our November video to see if the IRS ends up backtracking again, because you'll definitely want to prepare your clients either way. Okay. Next on the list, remember that two huge congressional acts were passed in 2021. Sure, you remember those. They were the Inflation Reduction Act and the Infrastructure Investment and Jobs Act. Let's talk a little bit about them. Actually, only one of them. We don't really have to worry too much about the Infrastructure Act. It really doesn't affect personal or business income tax, other than, people are going to earn more and there's going to be more clean energy, stuff like that. But the Inflation Act, on the other hand, has several provisions of which you should be aware. The first provision you should know about is the extension of the Affordable Care Act's Premium Credit Program. That was supposed to expire in 2022, but the credit has been extended to 2025. So no need for Mikey to show up for that one. Nothing's going to change for your friends on the insurance exchanges. Other changes coming from the Inflation Reduction Act are that your non-business energy and residential credits have both been extended through the 2030s, but with some slight changes and, biggerly, a name change. Just to make things even more confusing in the energy space, both of the credits have been renamed. The non-business energy credit has now been renamed to the Energy Efficient Home Improvement Credit. Its provisions have been extended to 2032. The Residential Energy Efficient Property Credit has now been renamed the Residential Clean Energy Credit and has now been extended until 2034. Now, when your head stops spinning, here are the small changes associated with those renames. The Energy Efficient Home Improvement Credit isn't much different than before. However, the annual limits for qualifying improvements now includes $150 for home energy audits, $250 for any Energy Star compliant exterior door, and $600 for other qualified energy properties such as central air conditioners and water heaters. Please note that roofing is no longer qualifying for the credit. All eligible improvements will also now require a product identification number, but that doesn't go into effect until tax year 2024. For the Residential Clean Energy Credit, the credit amount is now 30% for all clean energy production units that you add to your house, such as solar panels and wind generators. Please note that the credit will expire at the end of 2034, and it will actually start to phase out in 2032. If it doesn't get extended, the credit will be gone in 2035. Also, please don't forget that starting in tax year 2023, the new credit will also apply to battery storage technologies that have a minimum capacity of 3 kilowatts. This works well for California, where solar panels by themselves no longer qualify for the state tax credit and require some kind of battery storage in order to qualify. Our last discussion of the Inflation Reduction Act regards the Clean Vehicle Credit. It has also been extended until 2032. Some new changes though. It now allows a credit for previously owned clean vehicles and also for qualified commercial clean vehicles. That's a big change from the past when only new vehicles qualified for the credit. Your clients can qualify for a whopping $7,500 for the purchase of a new clean energy vehicle weighing less than 14,000 pounds and up to $40,000 for vehicles weighing more than that. Used vehicles are now in the mix, with customers being able to claim up to 30% of the price of the used electric vehicle, or $4,000, whichever is less. From 2024, car buyers will be able to transfer the credit from dealers at the point of sale, allowing them to down the purchase price immediately. The downside to this is that there is still a lot of confusion about which dealers and cars qualify for the credit due to strict rules about how much of the car has to be made in North America. The list changes daily, so the easiest way to figure out which vehicles qualify is to check out www.fueleconomy.gov. That's the place to go so when your clients ask you if their EV will allow them to get the credit. Hey, do you hear that rumbling? What is that? Was that the sound of an earthquake or the sound of inflation going up again? Well, the good news is that as of the filming of this segment, it seems like we may finally be seeing inflation tamper down just a bit. But inflation has been out of control for the past couple of years, and when it goes up, it might really be getting you and your clients down.
Going up, girls?
No, we're going down.
The good news is that tax season is the one time a year when inflation helps Americans out. That's because so many of our deductions and even some of our credits are indexed for inflation. That means we, as taxpayers, get bigger breaks every year. Boy, it's kind of echoey in here. Let's go back to the wall. Okay, let's start with the big inflation thing, The standard deduction. In the 2022 tax year, the standard deduction for those filing jointly or as a qualifying surviving spouse was raised $800 from tax year 2021, and we will see it rise yet again. But the real winners in the standard deduction lottery are the single folks, because proportionally, their standard deduction went up a lot more. It goes up $400 in 2022 and will go up another whopping $800 in 2023. Head of households got it pretty good too. Their standard deduction will increase a total of $2,000 from 2021 to 2023. As a reminder, your filing requirements generally match your standard deduction unless you have self-employment income or you receive passive investment income as a dependent. So, what are some of the other interesting areas where amounts are indexed for inflation? Well, your clients will, in most cases, see increases for the earned income credit and its associated income limitations. But an important client note, and there's Mikey again, the EITC amount for people without children fell dramatically from tax year 2021 to tax year 2022. The 2021 amounts were adjusted as a form of pandemic relief, but they have now fallen back to earth, and for the foreseeable future will be these lower amounts. Be sure to prepare your childless children who are eligible for the EITC of this change. Are you working overseas or do you have expatriate clients? If so, you'll see the foreign exclusion income amount rise as well. This is the amount your clients can earn while living overseas and still not pay a dime of federal income tax. Please note that California does not conform with the foreign income exclusion law, and your clients will have to add that income back into their local returns unless they are officially considered non-Californian residents for that time period. For those of you with clients that have high-paying jobs, the amount that they will have to contribute to the Social Security Trust Fund will be limited at a higher level, whether they are employees of someone else or working as a self-employed person. For tax year 2022, the amount of earnings taxable for Social Security moved up to $147,000. For 2023, the maximum rises unusually sharply to $160,200. As usual, 6.2% of wage income is payable as Social Security tax by the employee, and the employer pays an additional 6.2% themselves. Self-employment workers continue to have to pay double, 12.4%. Keep in mind that while Social Security contributions might be limited based upon income, Medicare contributions are not. All income is subject to the 2.9% tax for the Medicare program, though employees and employers split those costs too. Don't forget that those who make over $200,000 a year still pay an additional 0.9% Medicare tax due to the Affordable Care Act. Congress continues to discuss whether to remove the Social Security cap or to raise retirement ages as a means of keeping Social Security solvent, but has made no decisions as of the filming of this video. And if you think Congress will actually be able to agree on that one, I've got a very pretty bridge for sale that I'd like to talk to you about. Operators are standing by. Brooklyn Bridge is owned by New York State and is not actually for sale by our tax. Please do not send us money because we don't actually own the bridge. To actually buy the bridge, please reach out to New York State. Okay, let's continue on with the inflation adjustments. Want to contribute more to your retirement plan? Well, lucky for you, inflation has helped you out. For tax year 2023, your clients will be able to contribute up to $22,500 to their 401ks, which is up $2,000 from tax year 2022. And for your clients who are over 50, they can pitch in an additional $7,500 for 2023, up $1,000 from tax year 2022. For those with standard IRAs, they can contribute $6,500 in 2023, up $500 from 2022, and those 50 and older can still give $1,000 extra for either year, unchanged from previous years. In 2023, self-employed persons can contribute up to $66,000 to a SEP. That's an acronym for a Simplified Employee Pension Plan. That's up $5,000 from 2022, $61,000. And as usual, the contributions for self-employed folks are limited to 20% of their net self-employment income. Yes, the educator expenses deduction is now permanent, but for tax years 22 and 23, it even got better. The education expenses deduction now got raised to $300 per teacher, up from $250 in previous years. And our last topic before moving on to business stuff, we saw the gift tax exclusion amount rise to $17,000 per person per gift recipient for 2023. That's $1,000 up from 2022. So 2 grandparents can give 6 kids $204,000 without any estate or gift tax ramifications. You heard that correctly. That's $34,000 per grandkid because each grandparent can give each kid $17,000. And that leads us to our final inflation amount for personal returns. The estate tax exclusion rose this year to $12.92 million. That means that estates pay no tax on inheritance, lower than $12.92 million. And countdown alert, this amount is going to be cut big time, more than in half, when the TCJA provisions expire at the end of 2025. So start preparing your morbid jokes now. They'll come in handy for your 2024 client meetings. Now on to business tax changes, starting with mileage. Higher inflation and gasoline prices meant that the business mileage rate rose a huge 17% between 2021 and 2023. Additionally, for that same time period, medical and moving mileage rates rose 38% and charity mileage rose 28%. Mileage continues to be an extremely great deduction, so make sure you nag your clients to keep those mileage records accurate. The travel per diem rate, unfortunately, wasn't nearly as generous. It rose less than 2% to $98 in 2022 from $96 in 2021. The $59 rate for meals and incidental changes didn't change at all and stayed at $59 for both years and for 2023 so far. Don't forget that the standard travel per diem rates don't follow the standard calendar. They run October through September instead, so you'll always have 2 different travel per diem rates per year, and we will also be telling you what they're going to be come our November video. Section 179 deduction limits will rise a respectable 10% from tax year 2021 to tax year 2023. The maximum amount your clients could elect to deduct for Section 179 property placed in 2022 was $1,080,000, with phase-outs starting at $2.7 million. That rose to $1.6 million for tax year 2023, with phase-out amount starting at $2,890,000. And don't forget that bonus depreciation starts to phase out in tax year 2023. For tax years 2021 and 2022, the depreciation amount was 100% for any business placed in a business service. In 2023, the bonus depreciation amount reduces to 80% and goes down another 20% in 2024. Okay. Our final federal topic is something that businesses need to be aware of. The Inflation Reduction Act of 2021 introduced a brand spanking new corporate alternative minimum tax called the CAMT. That means that every business tax return now has to be calculated twice, just like personal returns do now. Your job just became more secure. Congratulations. Okay. That's it for the federal tax changes. I hope you enjoyed the video. Please don't forget to subscribe so that you can watch our end of year prep video coming out this November. Also, if you haven't signed up yet, you can always get credit for watching these videos by going to www.aardvarktax.com and taking one of our full courses. For those of you in California, there is a short associated California video companion to this update. If you're taking the California course, it will be in an upcoming hour. For everyone else, please click this button here and you'll be able to switch to the California video now. Oregon didn't have any major changes in state tax law this year, so no video for you Oregonians. Okay, that's it for us this year. I hope you have an excellent summer and we'll be talking to you soon.